y'all, I'm Laura Richardson with Relevate, and we're Real Estate Elevated, and we're bringing you another episode, and today we're going to be talking about how to finance that new property that you want to purchase. So there are lots of ways to go about this while keeping some liquidated cash in your pocket. A lot of people think that stereotypical, I have to have 20% down plus closing costs, and that's just not doable, especially with interest rates being where they are. How can you go about this in a way where you're not spending as much out of pocket? So we have a couple of things to talk through. The first one is just loan type. So when you start thinking about how you're going to fund the entirety of the purchase, typically you're going to talk to a mortgage broker or a local bank, and you're going to talk to them about financing. So with that financing, you have a conventional loan. You also have things that are government backed like a VA, USDA, FHA. There's also DPA loans, so down payment assistance. The latter group that I mentioned, those government backed programs, you can actually put as little as 0 to maybe 3 or 5% down. That's a huge difference in comparison to your conventional ones, where typically you're looking at more like 7, 10, 20 or more % in a down payment. So it could be really good to ask if there are any programs like that. So again, you're conserving that cash that's due at closing. Another good one that folks often don't know about is something called a physician's loan. So a physician's loan, if you're a PT, an MD, or a chiropractor, or anybody that's in that sphere, it's really good to ask about those because that's actually a 0% down loan, and it could be a great opportunity to kind of conserve that cash again. So something else to make sure that you're marrying up is the type of loan product with your criteria. So like I was mentioning earlier, a USDA loan. Those are meant more towards rural and agricultural type environments. So if you're shopping in, let's say ITB, downtown Raleigh, that USDA that's going to let you put as little as 0% down is not really going to marry up to the properties that you're looking for. So you got to keep that in mind when you're deciding how you're going to pay for that entirety of the loan. Another big thing is, are you contingent? So that buy-sell timeline. So we see this a lot when folks are trying to do what's called a tandem deal. Sometimes there has to be overlap. Sometimes you can actually do one and then the other. So it's really important when you talk to your lender and you say, I have a home to sell. Make sure they understand you don't have to sell that property. You need to know if you have to sell that property. I've actually seen this happen before when you fill out those initial 10 questions. There was a lender one time working with one of my clients. She filled out that initial questionnaire and said, yes, we have a home to sell, and it got marked as a contingent contract. Fast forward, I actually put her in touch with a different lender that I had worked with numerous times and just said, hey, let's figure this out. Are you really contingent or not? Come to find out, that questionnaire is what made it contingent. It was not that they actually had to sell that property before purchasing. A contingent contract in our market, being a seller's market, can be a little tricky because you think about the domino effect. So your buyer may cause you to not be able to buy your house. So this seller might have an issue with taking that risk. So it's really important to kind of flesh that out and decide, do we actually have to sell this and have those liquidated assets in order to make the next purchase? So if you aren't contingent, do you want to keep both homes? Do you want to rent that home out? Do you want to be the person dealing with the rental, or do you need to talk to a property manager? All of these are pieces that you want to line up before you start this process. Now, if you find out you're contingent, meaning you actually have to sell your initial property in order to buy the next one, look into bridge loans, HELOCs. You can talk about the CALC program. Ribbon has a good one. There are so many other entities out there, even some third parties that work with your lender to help you present as a non-contingent opportunity. So talk to your lender and see if there's anything that's outside the box that might be a way for you to actually make that additional purchase and then quickly sell the previous one. Okay, it doesn't mean you're holding on to it forever, but it at least lets you get the job done. Another one is gift money. So some folks do have family members that can kind of contribute towards their first home purchase, which is wonderful, and it's an opportunity, right? However, keep in mind they do have to be family, so blood-related family, and the funds have to be documented. So If grandma offers to give you the $15K that she's got hidden under the mattresses, grandma's going to actually have to go deposit all of that into a bank and have it documented and then sent to you. Your lender wants to see the transference of funds, okay? So we can't have any backdoor mafia deals, guys. So make sure that grandma plugs it into an institution and we've got documentation on the gift funds. Another thing to consider is getting closing costs paid for by the sellers. So there are two big pockets of money you're responsible for on closing day. Your down payment, which is your portion of the total that's due, right, that you have to pay, so that percent. And then you have closing costs. These are costs that are associated with buying a home, so things that go towards your lender, your attorney, etc. So like property taxes, things like that. Those closing costs can actually be paid for by a seller. This can be wrapped into a contract as part of the deal. There's actually certain loan products that allow a little bit more than others. Most conventionals, it's typically about 3% of the total, whereas a lot of your government-backed loans or ones where you're putting a sizable down payment, you can do up to 6%. So this is also something you want to double check with your lender because it is literally down to the penny what you can get from a seller. You do not want to go over that amount, okay? You're not going to be allowed to get more than that amount. So just keep that in mind when you're negotiating with the seller. You can't ask for $100,000 on a $200,000 house. That's not the way that it works. And then the last thing is make sure you're taking advantage of programs like with new construction. Sometimes they're third-party partners that they do lending with might have a substantially lower interest rate, but also be a little careful to read through that fine print and make sure they're not making up for it elsewhere, like additional costs. I've also seen the reverse of that where some folks will say, we'll put $10,000 towards your closing costs, but your interest rate is a whole percent higher, meaning you're actually paying for it just in the long term. So always double check, if you get this, then what? Okay, make sure you ask that question. You want to make sure it's a win-win for both parties. So these are just some quick little tips on how you can finance your next home purchase. I'm Laura Richardson with Relevate, and we will see you on our next episode.